Hi, good morning, everyone. Welcome to our session on 365 days of VAT in Oman. As a part of the sector-specific briefings we've been having over the last few days, today we focus on the transport and logistics sector, our second last session out of the 6 sector-specific briefings we've planned for you. My name is Abha Lekak. I'm a partner with KPMG's indirect tax practice. I'm based out of Muscat, been in the region for 4 years, and I've helped clients with VAT implementations as well as excise and customs matters. Overall, I've been assisting clients in indirect tax advisory and compliance matters for close to 16 years. In my regional role, I also assist the head of indirect taxes for the Middle East and South Asia, share certain responsibilities. Before I walk you through the agenda and I introduce the other speakers on today's webinar, a few housekeeping rules. Uh, One, questions. We encourage you to ask questions. You will not have FaceTime. You will not be able to speak on the call, but we will request you to put your questions in the Q&A tab that you see on the right-hand side of your screen. We will try and take as many questions as we can at the end of the session, but we encourage you not to hold up the questions until the end. Please put them in the chat box as and when they come to you, and the team will consolidate these and put them in the moderated session. We request you to provide your feedback at the end of the webinar when you're taken to the feedback screen. It'll only take a minute, but your input will allow us to customize and curate the future courses that we have for audiences such as you. And lastly, this session is being recorded, and a recording of this will be shared with you and perhaps also be put on social media for you to access and share at a later point in time. With that, let me walk you through the agenda for today's session. Over the next 1 hour, we'd like to provide you an overview of the developments from the VAT front in Oman, key VAT positions, especially in the context of the transport and logistics sector, procedural reliefs that the tax authority has extended in the last 1 year, our practical experience of compliances, some issues for consideration that still remain unaddressed in the context of the transport and logistics sector, mission critical items for businesses to consider coming out of the guidance issued by the tax authority, and at the end of the session, Q&A. On the webinar today, I'm joined by Manak and Abdullah. Manak is an associate director with our indirect tax practice. He's based out of Muscat, has been in the region and with us for over 1 year now, and serves clients across sectors but specializes in transport and logistics. He has been in the indirect tax advisory and compliance space for close to a decade now. Abdullah has been with us for over a year now, and in the last 1 year, he's gained a lot of experience in compliances as well as technical matters, and has built a great rapport with the tax authority, and assists clients amongst other sectors in the transport and logistics sector. With that, let's kick off the session for today. We first start with key developments that we've seen happen over the last 1 year. 16th of April 2021 is when Oman introduced VAT, and since then there has been a phased registration approach followed by the tax authority, divided over 4 phases, the last one going live on the 1st of April 2022. In the last 1 year, the tax authority has invested a lot of time and effort in ensuring that it creates awareness and disseminates information for taxpayers to improve their level of compliance. And we can see that with the decisions, with the guides, and other communication coming from the tax authority, as well as a few other bodies. On the next slide, we see that so far the tax authority has issued 6 decisions. Largely, these are in the context of registrations, where the tax authority has set out the monetary limit for mandatory as well as voluntary VAT registrations, and also set out the phasing of registrations. There's been decisions on zero rating of food items, which initially started with 98 items, then went on to over 400 items, and eventually more than 500 items, and the decision on zero rating of medicines and medical devices. On guides, the tax authority has published several guides, over 14 guides so far, some of them on sector-specific matters such as the transportation sector and the ones that we've been discussing over the last few days, some on procedural matters. While one may be inclined only to look at the guide that relates to their sector, it's important that you also look at generic guides like the related parties, reverse charge mechanism, profit margin scheme, capital asset scheme, because a lot of these set out principles which may be applicable to you. And even with the other sector specific guides, they may set out principles which may help you adopt certain positions that are not necessarily sector specific but generic in nature. Other communication coming from the tax authority is by way of press releases and notices, essentially allowing a relaxation on people who want to use simplified tax invoices, where you do not have to request an approval from the tax authority anymore. You can just notify them and confirm that you are issuing correct and valid simplified tax invoices, and that would be deemed compliance of the requirement to obtain an approval from the tax authority. The tax authority has also clarified that supplies to government bodies do not deserve a special treatment under the Oman VAT legislation. These will be treated at par with supplies made to private bodies. All of this information is available on the tax authority's portal for anyone who wants to access it. Obviously, some of this is available in English as well as Arabic, but some of this may not have been translated by the tax authority in English and is therefore available only in Arabic, like the transportation guide that we will talk about during the course of this session today. With that, we'll move on to the next section, and I'll ask Abdullah to kick off the section with key VAT positions that apply generally. Abdullah, over to you.
Thank you, Abha. As we know, VAT in Oman is applicable on supplies at the standard rate of 5%, unless the supply is specifically exempted, zero rated, suspended, or outside the scope of Oman's VAT. As a quick refresher, in an exempt supply, the supplier can neither charge VAT from the customer nor recover any input VAT incurred on purchase used to make such supply. On the other hand, in a zero-rated supply, the supplier can charge VAT from the customer at 0% and recover any input VAT incurred on purchase used to make such supply, of course, subjected to normal input VAT recovery rules. Also, in an out-of-scope supply, the supplier cannot charge VAT from the customer, but depending on the nature of the transaction, may be able to recover input VAT incurred on purchases used to make such supply. Finally, in a standard rated supply, the supplier can charge VAT from the customer at 5% and recover any input VAT incurred on purchase used to make such supply, and it's also subjected to normal input VAT recovery rules. So, how does one assess whether a supply is standard rated, exempted, zero rated, suspended, or outside the scope of for the purposes of Oman's VAT? Well, that is based on Oman VAT legislation. The Oman VAT legislation lists supplies that are exempted, zero rated, suspended, and outside of scope for Oman's VAT. So this slide here captures key supplies exempted, zero rated, outside the scope of Oman's VAT. I'll start with when affected within Oman. Supplies exempt from VAT include local passenger transportation, import goods such as military means transport, and it's part of the armed force, financial services, and some supplies related to real estate. Secondly, when affected within Oman, zero-rated supplies include international transportation, supplies to customers in notified special zones, supplies of crude oil, oil derivatives, natural gas, specified food items, and medicine. On the other hand, when affected outside of Oman, goods and services exported from Oman qualify for zero rating. Finally, some supplies that are outside the scope of Oman include supplies between members of a VAT group and transfer of business on a going concern. Please note, a special treatment usually comes with condition attached. So the exemption and zero rating are subjected to fulfillment of all conditions prescribed under the Oman VAT legislation. With that, I can handle the presentation to Abha to discuss the VAT position in the transport sector.
Thanks, Abdullah. Now, before we move on to transaction level details and VAT positions that are applicable to the transport and logistics sector, let's first understand that transport and logistics is a term of wide amplitude, and it has several lines of businesses and components. On today's session, we will be looking at transport services, transport related services. We'll be looking at travel agency related services, a supply of means of transport, and the supply of goods and services related to means of transport. Each of these has a different tax treatment, and before you arrive or conclude on the tax treatment, there are different criteria that you need to apply to see what sort of VAT position you are eligible to take. Whether the supply would be eligible for a special treatment, i.e., zero rating or exemption, or would it be treated as out of scope, i.e., not applicable to any VAT in Oman, or would it be standard rated where you would have to pay a 5% VAT? So first, let's start with the scope of transportation services and the implications for transportation services. When we say transportation services, it is the act of transportation in itself. In that, we need to look at whether the transportation is international transportation or local transportation, because each of these deserves a separate VAT treatment. And in that, when we look at local transportation, we need to see whether it's local transportation of goods or local transportation of passengers. But first, let's start with what is transportation service. And the legislation defines international transportation as transportation of goods or passengers from inside Oman to outside Oman, or transportation of goods or passengers from outside Oman to Oman. And when the transportation services are provided by way of a qualified means of transport, they may be eligible for zero rating. When a domestic leg of transportation is nothing but an extension of a international transportation, it may be eligible for zero rating, provided it is extended or provided by way of qualified means of transport. Now we look at the conditions, we will look at the place of supply on the next slide. Before we go to that, local passenger transportation is, when it comes to the exemption that Abdullah mentioned, limited to transportation of passengers within Oman, either by air or by land or by sea, and it only limits or includes organized public transport where there's a schedule, where the timings are known, the fares are published, and the routes are known. So chartered transportation is not local passenger transport that qualifies for exemption. Similarly, when it comes to land transport, it is only limited to transport provided through public taxis that would qualify for the exemption for local passenger transport, not specialized companies, and in the context of Oman, companies like O-Taxi, which would qualify for the exemption. If we move on to the next slide, we look at how transportation services are treated for Oman VAT purposes. Now, the considerations before you conclude on the VAT treatment is that a supply of goods? Is it a supply of passengers? Sorry, is it transportation of goods? Is it transportation of passengers? Where does it originate? Where does it terminate? As a result of this, where is the transportation deemed to have been provided? And to the extent provided in Oman, what should be the tax treatment? First, let's look at, on the first table, the treatment of transportation services when it relates to goods. International inbound transportation of goods, i.e., where the transportation originates out of Oman and terminates in Oman, is deemed to have been provided outside Oman. This is because of the specific place of supply rules that apply to transportation of services. The place of supply rules say that transportation services are deemed to have been provided where the transportation begins. So when we apply that rule, international transportation of goods that begins outside Oman and terminates in Oman is deemed to have been provided outside Oman. Because the place of supply is outside Oman, it is treated as out of scope for Oman VAT purposes. But when you have an outbound transportation of goods which originates in Oman and terminates outside Oman, because the transportation begins in Oman, the place of supply is Oman. So the supply is deemed to have been made in Oman. And by virtue of the zero rating provided for in the VAT legislation, this supply is zero rated. When it's an out-and-out transportation of goods, which begins outside Oman and terminates outside Oman, the supply is deemed to have been made outside Oman and is therefore out of scope for Oman VAT purposes. When it's a local transportation of goods which originates within Oman and terminates in Oman, the place of supply is Oman, but such supply is standard rated unless it's specifically eligible for certain zero rating. For example, if the supply is made to the oil and gas sector and qualifies for zero rating available for the oil and gas sector, or the supply is made for special zones and is eligible for zero rating in the context of special zones. Coming to passenger transport, similar place of supply rules apply. So when it is an international inbound transportation of passengers, which originates outside Oman, terminates in Oman, the place of supply is outside Oman. So it's out of scope for Oman VAT purposes. An outbound transportation that originates in Oman, terminates outside Oman, is deemed to have taken place in Oman and by virtue of the VAT legislation is eligible for zero rating. Again, an out-and-out transportation of passengers originating outside Oman, terminating outside Oman is deemed to have taken place outside Oman and is therefore out of scope for Oman VAT purposes. Local transportation of passengers, as I mentioned on the previous slide, is eligible for exemption if it is public transport, but it could be eligible for zero rating or standard rating if it isn't public transport. With that, if we move on to the next slide, we now look at what are transport related goods and services. Because when provided in the context of international transportation, these could also qualify for zero rating. If you look at the VAT legislation, it clarifies the scope of services related to transportation. These include port fees, customs clearance, air navigation services, supply of crew members, loading, unloading and reloading services, certain cargo related services, certain paperwork where it comes to preparation or amendment of bill of lading, airway bills, seaway bills, and a few others services which are mentioned on the screen. But remember that this is an inclusive list. It is not an exhaustive list. The basic principle is any service that is directly necessary to complete the transportation of goods or passengers would be a service related to transportation of goods and services, which if in the context of international transportation could qualify for zero rating. The legislation further clarifies what could qualify as services related to international transportation. Again, this list is not exhaustive, it is only illustrative, and it includes goods and services for use or consumption on the qualifying means of transport. I know I've used the term qualifying means of transport for some time now, and we will look at what is qualifying means of transport in the subsequent slides. But international transport related services include goods and services for use or consumption on qualifying means of transport, services undertaken for the transportation of goods, again, loading, unloading, stacking, packing, certain cargo related services that we've looked at in the earlier list of services, renting of containers, machines, as well as equipment that is used in the transportation of goods. And anything that is necessary to complete international transportation of goods as well as passengers. If we move on to the next slide, we look at the tax treatment or the VAT treatment of transportation related goods or services. Now, in this, the guide makes a distinction on services provided by the same person providing the transportation services, which means that the transportation itself and the transport related services are a bundled supply. And when that happens, the place of supply, which is where is the service deemed to have been provided, would depend on where the transportation service is deemed to have been provided. The tax authority distinguishes this from where transport related services are provided independently, i.e., not by the person who's undertaking the transportation. In that case, different place of supply rules would apply, i.e., when these are provided by a supplier who's registered for VAT purposes in Oman, the place of supply is deemed to be Oman. So let's look at how the supply of transportation related goods and services is treated from an Oman VAT perspective. When the transaction of transport related service is bundled with transportation service and provided by the same transport service provider in the context of inbound transportation, which originates outside Oman, terminates in Oman, the supply is deemed to have been made outside Oman and is therefore out of scope for Oman VAT purposes. When these are provided in the context of outbound transportation of goods, i.e., originating from Oman, terminating outside Oman, the place of supply is Oman. And by virtue of the zero rating available for transportation related goods and services, international transportation related goods and services, these would be zero rated. So far as local transportation of goods are concerned and services related to local transportation of goods are concerned, these would be standard rated. When transport related goods or services are supplied separately or independent of the transportation, in the context of international inbound transportation that originates outside Oman, terminates in Oman, the place of supply, when the supply is made by a person registered in Oman, is zero rated. When it's outbound transportation originating in Oman, terminating outside Oman, it's the place of supply is Oman, and such supplies again are zero rated. In the context of local transportation of goods, these are standard rated. If we move on to the next slide, we continue to elaborate on transportation related services, but this time in the context of passenger transportation. Now, while this does not come out of the legislation, the guide clarifies or expands on the scope of international passenger transport related goods and services. And it acknowledges that reservation services, brokerage services, additional charges such as extra luggage, port, airport or passenger fee, entertainment services for anything that is consumed during the trip, all of this is an extension of the passenger transportation, can be considered as goods and services related to international passenger transportation, and could qualify for zero rating. Now, while the guide makes a generic statement on these supplies being zero rated, we would we would proceed with caution. We would apply the same yardstick as we did on the previous slide, and you would, as a taxpayer, want to look at whether these ancillary or incidental supplies are provided separately, i.e., by a person other than the person who's providing the transport services, or are they bundled and provided by the same person providing the transportation services. Are they in the context of inbound international transportation or outbound? And then decide on what the tax treatment could be, because that could vary depending on the criteria that we've just walked you through. When it comes to travel insurance related to actual transportation, i.e., departures, cancellations, and the insurance for travel itself, the guide suggests that it's zero rated. Again, you would need to look at whether it's bundled, whether it's separate, whether it's inbound, whether it's outbound. But it also clarifies that any other travel insurance for loss of baggage or cancellation of hotel accommodations, the tax treatment would have to be assessed separately. In terms of goods, when the goods are purchased overseas and or let's say on the aircraft and brought into Oman, now the purchase and the import could have implications depending on whether these are within customs limits which are prescribed for personal baggage, whether these are used household equipment that you're trying to bring in which case they may not have a VAT implication, but anything in excess could be subject to VAT at the time of bringing them into Oman. Similarly, when you buy goods in Oman and you take them with you while traveling overseas, these could qualify as zero rated goods when you take them from Oman, but you would obviously need to look at the implications in the destination state. With that, if we move on to the next subject on travel related items, we look at travel agency and travel agent related supplies on the next slide. And the guide clarifies that where the transportation service or the travel agency services are provided in the name of the original transportation provider, the services are deemed to have been provided directly by the transport provider. The travel agency is merely acting as an agent. The VAT therefore will depend on the underlying transportation arrangement, and any brokerage fee charged by the agent will be subject to VAT depending on whether this is a domestic transport, international transport, and whether it qualifies as international transportation related service. When the transportation services are provided in the name of the travel agent, then that person, that travel agent, is considered as a person responsible for making the supply as well as the VAT thereon. And the VAT that applies is on the total value of supplies, not just a portion of brokerage fee or agency fee, which is charged by the travel agent. With that, we move on to the next line of business or next line of service within the transportation and logistics sector, which is supply of qualifying means of transport. Now, generally, supply of qualifying means of transport is zero rated, and supply of goods or services in relation to qualifying means of transport is also zero rated. Now, the legislation defines what the scope of qualifying means of transportation is, but the guide allows us a lot of clarity in terms of the conditions that ought to be satisfied by a supplier in order to claim the zero rating. When we look at qualifying means of transport, a scope defined in the legislation includes aircrafts, ships, boats, or floating structures which are designed or prepared for use in commercial transportation of either passengers or goods. But these do not include any aircrafts, ships, boats, or floating structures which are designed or prepared for recreational or sporting purposes. They would not be eligible for zero rating. Qualifying means of transport also includes motor vehicles, trains, or similar mode of transport which is designed or prepared for use in public transportation of 10 or more passengers. So anything that is for less than 10 passengers will not qualify for zero rating. Any mode of transport which is for 10 or more passengers but not for public transport will not qualify for zero rating. And lastly, motor vehicles with payload capacity of over 2 tons. Now, a few things which are clarified in the guide. Since the zero rating extends to qualifying means of transport used in transportation of goods, what is the scope of goods? And the guide clarifies that goods includes raw materials, containers, luggage, animals, wastes, and anything else that is capable of being transported in containers or transport units. Now, in the issues for consideration, Manak will touch upon a few items which are not in this list, and how do you, as a supplier of qualified means of transport, treat them when you're trying to make a sale of a vehicle. Registration requirements. The guide clarifies that in order to qualify for the zero rating, provided all other conditions are met, this means of transport should also be registered. Aircraft, ships, boats, or floating structures must be registered with the competent authority. Motor vehicles for public transportation of passengers must be registered as a commercial vehicle by the Directorate General of Traffic at ROP, and motor vehicles with payload capacity of over 2 tons must also be registered as a commercial vehicle by the Directorate General of Traffic at ROP. In the absence of the proof of these registrations, you will not be eligible for zero rating. In terms of what could qualify as motor vehicles with payload capacity of over 2 tons, the guide clarifies that to qualify as a motor vehicle, the vehicle should be designed to move on wheels and not or and operated mechanically by means of an engine. For example, a semi-trailer or the sale of a semi-trailer may not qualify this condition because if it's not propelled by an engine. Certain specific inclusions and exclusions. The guide clarifies that dual purpose means of transport, i.e. means of transport that are intended for transportation of goods as well as storage of goods. By way of example, they've mentioned cement mixers, refrigerated trucks, water tanks. All of these would still be eligible for zero rating if the primary purpose is to transport the cargo, not store the cargo. In that, the tax authority has also clarified in the guide that ancillary equipment like cranes, tanks, refrigerators, mixers that are mounted on vehicles could be eligible for zero rating only if they are adequately fixed to the vehicle and assist in the transportation. This does not require the condition of being permanently fixed, only adequately fixed. Lastly, specialized vehicles which are designed or used to transport material around a single site. It could be a construction site, an industrial site, and by way of examples, they've said bulldozers or cranes. These are not considered as means of commercial transportation and not registered and are not eligible for zero rating. And lastly, the tax authority requires the supplier to get a declaration when the supply is in case of chartered means of transportation. On the next slide, we quickly wrap up this section with the treatment of supply of goods and services related to qualifying means of transport. These are also subject to zero rating, provided certain conditions are satisfied. So, what is the scope of goods and services related to qualifying means of transport? These include goods and services for maintenance, repair, or conversion for the qualifying means of transport. Spare parts and consumables for the qualifying means of transport, or components that have been permanently installed or affixed to the qualifying means of transport. The specific inclusions and exclusions are supply of fuel or consumables for the regular operation of the means of transport is not eligible for zero rating. And if spare parts or goods are supplied, but they're not, so only goods which are installed or used by the person performing the maintenance, repair, uh, of the qualifying means of transport will be eligible for zero rating. Any over-the-counter sale of parts or goods which you cannot evidence were installed or used in performing the maintenance or repair will not be eligible for zero rating. And the tax authority requires that for you to evidence the eligibility for zero rating, you have a declaration and you have records to prove that the goods or services that you've zero rated were supplied for qualifying means of transport. So you probably want to take a copy of the commercial registration and a declaration from the customer uh, before you zero rate these supplies. With that, we'll wrap up this session, this section, and I'll ask Manak to come in and walk us through procedural reliefs which have been extended by the tax authority and our experience of compliances. Manak, over to you.
Thank you, Abba. and good morning to all the attendees. Over the last 1 year, the Tax Authority has extended several procedural reliefs relating to VAT compliances. To start, with the due date for filing the VAT return and making the tax payment, the VAT legislation requires the taxpayer to file the VAT return and make the tax payment by 30th of the month succeeding the end of the tax quarter. The Oman VAT legislation does not allow automatic extension to the VAT due date if it falls on a weekend or a public holiday. But in the Financial Sector Guide, the Tax Authority has clarified that if the VAT return and the payment due date falls on a weekend or a public holiday, it gets shifted to the next working day. On exchange rate, in case of transactions effected in foreign exchange, the VAT legislation requires the VAT amount to be converted into Omani riyals using the average buy and sell rate published by the Central Bank of Oman on the date of supply. The CBO rates for each day are updated before 2 p.m. but not consistently at the same time. In the Financial Sector Guide, the Tax Authority has clarified that if the CBO exchange rate is not available on the date of supply, the taxpayer can use rates published on the previous day. Moving on, unlike VAT legislations in other GCC countries that generally require a business to issue a tax invoice within 15 days from the date of supply, the Oman VAT legislation does not prescribe a timeline. But the Financial Sector Guide, the Tax Authority has clarified that invoices should be issued within 15 days from the date of supply. The taxpayers also have an option to issue summary tax invoices at the end of the month on all supplies made during the month, which is practically being followed by most of the banks. Technically, the summary tax invoice is required to contain all the details required on a normal tax invoice. But the Financial Sector Guide has clarified that if the taxpayers has challenges in incorporating all the particulars on the summary tax invoice, the taxpayer can reach out to the tax authority to get a special dispensation in this regard. Moving on to clarifications, unlike the VAT legislations in other GCC countries, the Oman VAT legislation does not allow taxpayers a formal mechanism to obtain advance rulings or clarifications from the tax authority. But in our experience of dealing with the tax authority, we have had fair share of success in obtaining private clarifications on behalf of the taxpayer. Now, these clarifications, since private, are only binding between the taxpayer and the applicant taxpayer. On input tax apportionment, the VAT legislation requires a taxpayer effecting both taxable and exempt supplies to undertake input tax apportionment working at the end of every tax quarter, followed by an annual true-up or a true-down as the case may be. In the Financial Sector Guide, the Tax Authority has clarified that subject to satisfaction of certain conditions, a taxpayer may compute input tax apportionment for the first 3 quarters of a tax year based on previous year's partial exemption ratio and the last or the 4th quarter based on actual figures. To avail this relaxation, the tax authority does not require the taxpayer to obtain any approval, but it is always advisable to notify the tax authority to avoid any surprises during future audits or assessments. On refunds, unlike the GCC countries, which took a slightly longer time to initiate the refund claims after the implementation of VAT, the tax authority in Oman started processing and disbursing refund claims filed by the taxpayers relatively early. In our experience, genuine claims have been credited to the taxpayer's account within 2 to 3 months from the date of filing the refund claim. Also, in terms of procedure, the taxpayer is now required to file a quarterly refund claim through the taxpayer checklist separately and not at the time of filing the return. On deemed supplies, if we look at the Financial Sector Guide, it has been clarified that the provision of deemed supply may not trigger in certain situations where the fees are getting waived. That is, there is some supply made without consideration, but certain conditions are required to be satisfied. The conditions essentially require that the fees is getting waived for genuine commercial reasons. The services relating to waived fees do not require the purchase of any directly relatable goods or services, and the fees are waived for the existing customers of the bank who would have separately paid or will in future pay consideration for other services. And finally, the tax authority has been allowing deferment of VAT payable on import of goods to the date of filing the VAT return instead of paying it upfront in cash but on a submission of a bank guarantee. This has helped many taxpayers optimize their working capital requirements. Having said that, it is necessary for the taxpayers who imports goods under deferment to monitor their bank guarantee balance with the tax authority on a regular basis. Every time a taxpayer imports goods under deferment, the VAT due is reduced from the value of the bank guarantee. So in tax periods where a taxpayer has significant imports, the bank guarantee may be depleted fairly quickly, and if the bank guarantee balance with the tax authority is lower than the VAT due on the next import, the custom clearance could be stalled and could lead to demurrage. Moving to the next slide on our experience of compliances. In the past 1 year, while filing these returns for the fourth quarters, we have seen some important points which I'd like to discuss. Unlike the other GCC countries, among other things, in Oman, a taxpayer is also required to report details of purchases and sales of capital goods and procurements which are outside the scope of VAT. In our experience, these details are not properly tagged in the IT systems and as a consequence, not necessarily captured or captured incorrectly by the taxpayers. To avoid penalties for incorrect reporting, it is critical that taxpayers may find ways of capturing and reporting these details correctly in the VAT returns. In case of import of services, the VAT legislation requires taxpayers to put a note on the overseas vendor's invoice stating that the VAT liability is paid under the reverse charge mechanism. In our experience, it is not uncommon for the taxpayers to miss this requirement, which technically is a non-compliance. In case of import of goods, it is critical to ensure that all imports made either directly or through agents where the taxpayer acts as the importer on record are captured correctly. It is equally important to ensure that the custom documents, i.e. the Bayern, are in the name of the taxpayer, especially when a third party is engaged to clear the goods. Unless the taxpayer owns the good at a time of import and acts as the importer on record, the taxpayer may not be eligible to claim the credit of import VAT so paid. On input credit, unlike most of the GCC countries that only allow taxpayers to claim input credit of the VAT on procurements in the same tax period or the subsequent tax period, the Oman VAT legislation provides a period of 3 years. Therefore, it is advisable to claim input credit only where supporting documents are in place and there is no doubt on the eligibility of credit. Excess claim of input credit could result into short payment of VAT and as a consequence, additional tax and administrative penalties. On foreign exchange, as we discussed in the previous slide, the exchange rate should be the average buy and sell rate published by the Central Bank of Oman on the date of supply. Unlike UAE, Oman does not specifically allow taxpayers to rely on sources like Thomson Reuters or Bloomberg. We've already discussed the refund in the previous slide, and hence I'll move to certain other VAT compliance related aspects which are specifically important for the transportation sector as well. On other VAT related aspects, as we have seen in the guides published for oil and sector, for transportation, and also for supplies made to special zones, the guides issued by the tax authorities requires the supplier to retain confirmations and declarations on the conditions for zero rating. It is indispensable for the suppliers to have these confirmations and declarations on record, and also for the recipients who are issuing these declarations to examine whether the conditions for zero rating are genuinely satisfied. Adding appropriate indemnities in these declarations will only help with recourse in case of any future dispute on the tax positions adopted. Considering these complexities and peculiarities around compliance in Oman, it is essential for the taxpayers to have an efficient and effective compliance process. To help clients achieve this, we at KPMG follow a technology-enabled approach to assist clients in building a robust and effective VAT compliance process. As we move to the next slide, you would see a snapshot of the KPMG compliance solution, which is designed to support all sector clients. As part of this solution, we have a tech-enabled process to cater to clients whether the data is available in a structured form coming from sophisticated ERPs like a SAP or an Oracle, or in unstructured form. The data, once shared with KPMG, is converted into a machine-readable form, and then it goes to the proprietary solution, where about 80 plus validation checks related to data sanity, consistency, and accuracy are undertaken. After undertaking manual adjustments on account of such validation errors, the VAT returns are auto-generated from the KPMG solution, along with other useful reports and MIS dashboards such as reconciliation and trend analysis. With this, we aim to automate the compliance process with minimal human intervention. Moving to the next slide on issues for consideration. While the guides have provided clarifications on various matters, there are still certain issues which require due consideration. Aviation and marine fuel. Supply of aviation and marine fuel may have different implications depending upon whether these are getting consumed on an international voyage or a domestic one. The oil and gas sector guide did clarify that the aviation and marine fuel will be eligible for zero rating if used or consumed on a qualifying means of transport departing from Oman on an international voyage, but subject to certain conditions. That is, the fuel or consumables are supplied at an international port, airport, or comparable facility, and supplier maintains evidence that the fuel or consumables are placed into the qualifying means of transport departing from Oman. While the supplier may have practical issues in maintaining such evidence, following this guidance, it becomes important for supplier to maintain all the available evidence and also take a declaration from the recipient to safeguard from any future risk before applying such zero rating. Next, supply to armed and internal security forces. As Abdullah mentioned in the earlier slides, there's an exemption available on goods imported for the armed and internal security forces. There are often seen business arrangements in Oman where certain goods, such as military means of transport, are imported into Oman by a company for the armed forces. The imported goods are onward supplied by such company to the armed forces after undertaking minor modifications such as painting, etc. In this regard, the companies, when making onward supply of imported goods to the armed forces in Oman, can explore the possibility of claiming such exemption on the local supply. Having said that, it is equally important for the companies to charge VAT and not extend the exemption on the value of modifications undertaken locally in Oman, in which case the invoices being issued to the armed forces will also need to have a proper breakup between the value of imported goods and the value of modifications. The companies will also need to evaluate this from a commercial purpose since the value added locally will get disclosed. Moving on to the supply of commercial vehicles for non-commercial use. As Abba mentioned in the earlier slides, there may arise situations where certain commercial vehicles are supplied for a non-commercial use. Some of the examples for these may be ambulances supplied to a hospital, or let's say a road sweeper truck supplied to government entities. While these vehicles may fit into the definition of commercial vehicles, and these are not used for commercial transportation of goods or passengers, they may not be eligible for zero rating. Then there are other examples as well, such as a horse body truck, which may be used for transporting horses. Now, since the exemption covers that goods for transportation includes animal as well, and therefore a horse body truck should be eligible for zero rating applicable to the supply of such qualifying means of transport. In such cases, it becomes imperative for the suppliers to be extra cautious while applying the zero rating on supply of qualifying means of transport, and also preferably ask for declarations cum indemnities to safeguard from any additional tax or penalties in future. VAT treatment for last mile delivery support in Oman. There are routine arrangements between transport sector players, where the local players in Oman are engaged by overseas transport players to assist in providing the last mile or the local delivery support in Oman. In these arrangements, usually the customer has contracts with the overseas vendors to transport goods from a place outside Oman to Oman. The overseas vendor does arrange the transportation and pickup from outside Oman, and thereafter may engage a local player in Oman just to provide the last mile support and transport goods from the port to the place of customer in Oman. In these arrangements, while the goods does originate from outside Oman, the services performed by the local transport player in Oman is limited to the local leg and therefore may not be eligible for zero rating, which is extended only to international transport and related services. It is thus important for transport players to charge and recover applicable VAT on such domestic support rendered in Oman. Lastly, on zero rating for transportation or related services to special zones. As we all know, the zero rating on services provided to special zones is based on a condition that the services are used for purposes of carrying out activity in the special zone. Now, a transport player may be engaged in providing transportation to and from the special zone or other activities, say storage related services to the special zone. Zero rating on all these activities will need to be analyzed and will depend upon the nature of the activity. For example, storage services rendered to a special zone customer in a warehouse which is based in the mainland may not be eligible for the zero rating as the warehouse is not located in the special zone. Therefore, it's imperative for a taxpayer extending zero rating special zones to analyze these services on a case-to-case basis and also back it up with declarations and indemnities as safeguard in case of any future concerns. With this, I'll hand over the presentation back to Abha to discuss the key next steps.
Thanks, Manak. So, mission critical items for businesses. What do we need to do in light of the transport and logistics sector guide? Examine if supplies are eligible for zero rating or exemptions. Any special treatment comes with conditions attached. So make sure before you apply a special treatment, you have all the documents and you have evidence that you've satisfied all the conditions. Wherever in doubt, seek clarifications from the tax authority. Wherever in doubt about the nature of means of transport, seek evidence from your customer. Ensure that the declarations are correctly received and are on record for you to produce at the time of audits or assessments. In light of the guide, if you need to revisit positions, do them voluntarily. If there's any course correction required, do it now. If that means that you need to revise contracts or purchase orders or any documented agreement that you have with your customers, you will need to start commercial negotiations to be able to achieve that. If it means that you need to change your accounting, your ERP systems, your customer masters, vendor masters, or your vendor management system, you will need to initiate that action now. Make sure you communicate. Communicate with your internal as well as external stakeholders. External stakeholders includes your customers, but also includes the tax authority. Internal stakeholders, you need to keep abreast with changes, any change in tax position, which could have an impact on your cash flows or profitability. In our experience, we've seen most omissions or errors occur because of lack of knowledge at the user's end. The user could be someone who's passing the accounting entries, user could be someone who's drawing up the POs or contracts, user could be who's someone trying to sell the service or the goods. So make sure you take user trainings on an ongoing basis so that they know the positions that the tax authority is likely to take at the times of audits or assessment. At the end of the day, your reporting obligation with the tax authority is in the form of VAT returns. So make sure that you're reporting the right numbers and paying the correct tax. If because of the guide or clarifications or any other reasons, you need to course correct or revise your returns, do it voluntarily and make sure that the returns are up to date and correct. As you may have seen, the penalties for non-compliance are eye-watering and audits and assessments are just around the corner. With that, we'll wrap up the session. We'll quickly move to Q&A. I'm conscious of time, but we'll extend the session by the next 5 minutes to be able to take a few questions. I'll put the first question to Abdullah. Abdullah, is VAT applicable on the supply of cruise ships?
Thank you. As specified on the transport sector guide, aircraft, ships, boats, and floating structures designed or prepared for use in commercial transportation of passengers or goods would be eligible for zero rating, providing these are not used for recreational or sporting purposes. Cruise ships are generally used for recreational use and not for commercial transportation of passenger or goods. Therefore, cruise ships will be eligible for zero rating and should be liable to VAT at the standard rate.
Thanks, Abdullah. I'll put the next one to Manak. The question is, can zero rate apply only for supply of means of transport on a charter basis, or will it also apply when there is a purchase of means of transport?
Thank you, Ava. So if we see the zero rating, which is extended for supply of qualifying means of transport. Now the supply includes lease, charter, or sale, all of them. So if I'm purchasing or taking a qualifying means on transport on lease, until and unless it qualifies as a qualifying means of transport, I would be eligible for zero rating, subject to the conditions as you already discussed, that it should be registered for commercial purposes and should be intended for commercial transportation of passengers and goods. The zero rating should be eligible.
Thanks, Manak. I can take the next one. When a transport service is provided to a company engaged in oil exploration, what would be the tax treatment? As I mentioned very briefly in the slides that I presented earlier, that if transportation services are provided to the oil and gas sector and satisfy the conditions for zero rating on goods and services related to the oil and gas sector, they would be eligible for a zero rating. The conditions essentially require that the supplies are only directly and exclusively related to upstream and midstream activities. So if the transportation is related to downstream activities, they will not qualify for the zero rating. The supplier is registered with the GSRS system. The recipient is registered with MEM as a operator. The supplies are not of services which are exempt, which transportation services aren't. The supply is not of goods on which input tax credit is blocked. And if motor vehicles are supplied for commercial purposes, they shouldn't fall within that restriction. And the supplier and recipient are both registered for the purposes of Oman VAT. If all of these conditions are satisfied, then the supply of transportation services or supply of means of transport for upstream or midstream activities in the oil and gas sector could qualify for zero rating. I will put the next question to Manak. Manak, does zero rating for qualifying means of transport also apply to local transportation?
So again, I think the supply of qualifying means of transport, if I'm supplying a means of transport which is used for commercial transportation of passengers and goods, which would include local transports also, the zero rating will apply. For qualifying means of transport supply, it is not necessarily that they should be used only in international transportation. They can be used for commercial transportation of goods or passengers which will include local transport as well.
Thanks, Manak. I can take the next one. This is not specifically related to the transport and logistics sector, but is a generic VAT question. Upon registering for VAT, can old invoices be claimed for purchases? If yes, how long before the registration can we claim invoices after registration? So just to simplify the question, I think the question relates to recovery of input VAT incurred on purchases prior to registration. Can these be claimed? The answer is yes. The VAT legislation does allow taxpayers to recover input VAT incurred on purchases made prior to registration, provided certain conditions are satisfied. In terms of duration, how long back can you go? If it's goods, you can go back 3 years in time. But one of the conditions that need to be satisfied is that the goods on which you intend to claim input tax credit are in stock or are in your possession when you are looking at claiming input tax credit. For services, you can go back 6 months in time. In order for you to recover input VAT credit, you would need to ensure that all other input tax recovery related rules are satisfied, i.e. these are used in making taxable supplies, you have valid tax documents for you to be able to claim it. In addition to that, you would also need to apply to the tax authority in a format to be specified of your intention to recover the input VAT credit, and upon approval, you can put that on your return and claim it. I'll put the next question to Manak. What is the VAT implication of service charges shown separately in tax invoices for international air ticket as well as domestic air ticket?
Thank you, Abha. So let me split the question into two parts. First, for service charges relating to domestic transportation. If we see the exemption which is there, it is only for domestic transportation and not for related services. So when I charge service charges on domestic transportation, the exemption for that may not apply. However, there's if I'm supplying a, let's say, a composite supply where the service charges forms part of the air ticket price and one consideration is recovered, we may explore the possibility of claiming such exemption on service charges as well. However, when I come to international transportation, the zero rating which is there, that is for transportation activity and also for related goods and services. Now, I can say that service charges are in relation to the international transportation activity, and therefore the zero rating should apply. But again, I would need to be a little circumspect of how the arrangement is. Am I treating it as a composite supply? Is there a travel agent also involved in this who is recovering the service charges as their own considerations? So there may be certain arrangements which needs to be explored. But as a general phenomenon, like I mentioned, we can explore the zero rating for service charges, but the exemption may be a little difficult to claim on that side.
Thanks, Manak. The questions are still coming in. We will have to limit them, but let's take the last two questions with today's session. Manak, I'll put the next one to you. Is VAT applicable on reimbursement of Bayern charges by a clearance agent from the actual importer?
Okay, thank you, Abbas. So reimbursements of Bayern charges. Reimbursements are liable to VAT as a general phenomenon. Now, if we look at guides in neighboring regions, they say that the reimbursements should take the color of the main supply. Bayern charges, if you look at the Bayern charges, there's no zero rating or exemption available on Bayern charges. VAT does apply on it. And therefore, if I'm taking a reimbursement for such Bayern charges, it should be applicable to Oman VAT as well.
Just to add to what Manak said, typically we've seen when Bayern charges are paid, these are paid by clearing agents in the name of and on behalf of the actual importer. So to the extent the Bayern documents and the Bayern charges are paid on account of the actual importer, and that's evidenced by the document, the customs clearing agent may be able to classify these as disbursement and treat them as out of scope for Oman VAT purposes. So I think the first step of distinction you need to make as a clearing agent is whether this is a reimbursement or whether it is a disbursement. To the extent it's a disbursement, you can treat it as out of scope. I'll take the last question, which is on refunds and taxpayers checklists. I'll combine three of them. Whether taxpayer checklists need to be filed when there is no refund. If there is a refund in one quarter, which is not claimed as refund, can this be adjusted in the next quarter? And when will the tourist refund scheme be implemented? So far as taxpayers checklist is concerned, at the moment, the tax authority only expects businesses that are in a refund position and intend to claim a cash refund of their tax to file the taxpayers checklist on a quarterly basis or an annual basis. In the last quarter, the tax authority did announce its expectation of requiring all taxpayers to submit the taxpayer checklist regardless of their tax position, but that announcement or that expectation has been revoked. It may be introduced in the future, but currently only people with refund positions need to apply for the refund through the taxpayers checklist. If you have a refund in one quarter, which you haven't claimed as cash refund, you have the option of carrying it forward to the next quarter and adjusting it against any liability of VAT that you may have in the next quarter. In that case, you do not need to file a taxpayer's checklist and there is no action pending at your end. This will show as your VAT balance with the tax authority in your login portal, which will be available for you to set off your liabilities in the next quarter against. So far as so far as tourist refund scheme is concerned, at the moment the tax authority is in the process of looking at implementing these. It hasn't been implemented, and there is no announcement in terms of timelines as to when this is likely to be active. There have been a lot of questions or comments on whether we will be sharing the slides. Unfortunately, we will not be sharing the slides, but we will be sharing a recording of this session with you for you to look at the matter or content which was presented during the course of the session. With that, we'll wrap up today's session. Thank you everyone for your participation. We hope you found this helpful, and we wrap up our session today, but we do have our session on consumer and retail industry tomorrow, and we'll encourage for those of you who are interested to join the session tomorrow. Thank you for your time. Have a great day.
Thank you.
Thank you.